Fala pessoal, tudo bem? Primeiramente, desculpa pelo atraso, a gente estava com um probleminha aqui para se conectar, mas agora deu tudo certo. Acho que a gente pode dar início aqui ao nosso webinar. Eu acho que muitos de vocês aí já conhecem um pouco da dinâmica que a gente tenta implementar nesses calls de atualização, mas começando do começo, é um prazer ter todos vocês aqui com a gente hoje. Meu nome é Rodrigo Aloy e hoje eu estou representando o time de Strategy and Research aqui da HMC Capital. E também todo o time da Gama Investimentos, que é a gestora local responsável por oferecer os fundos locais da Man Group aqui no Brasil. Eu gostaria de agradecer em nome dos dois times a presença de todos os participantes que estão aqui com a gente hoje, tanto os investidores quanto os parceiros de distribuição do fundo. Por último, obviamente, eu queria agradecer também todo o pessoal da Man e principalmente o Tarek, que é a presença constante nos eventos que usualmente a gente realiza a respeito da Man e do Target Risk aqui no Brasil. É, e o Tarek é também um dos principais porta-vozes aí do programa em várias outras regiões do mundo. Então, um agradecimento especial para ele que separou um tempinho para estar com a gente aqui hoje. Esse webinar, como vocês sabem, ele é parte do nosso processo de atualização sobre a estratégia Man AHL Target Risk, que é distribuída aqui no Brasil há bastante tempo já, tanto na versão redeada quanto na versão com exposição cambial, exposição a dólar. E a ideia aqui é aproximar o investidor brasileiro da Man, que é uma das gestoras mais tradicionais, relevantes e longevas do mundo, com track record bastante extenso. Para organizar melhor a dinâmica do nosso call, a gente organizou da seguinte maneira. Primeiro, uma sessão em inglês com o Terry, para que ele possa fazer a exposição dele. Ele provavelmente vai passar um pouco sobre o entendimento da Man a respeito do outlook, do que tem acontecido aí em termos de desenvolvimento de mercado, e como esse cenário tem afetado diferentes classes de ativo, e também vai passar também um pouco sobre a performance recente do fundo e o que a estratégia pode agregar para o investidor brasileiro. Na segunda e última sessão, a gente vai ter uma sessão de perguntas e respostas, para que vocês possam tirar suas dúvidas diretamente com o Tarek. As perguntas podem ser feitas tanto em português ou em inglês, usando sempre o chat de Q&A aqui embaixo, e podem ser feitas a qualquer momento durante o call. Eu vou tentar organizar todas as perguntas que chegarem aí da audiência, mas se não for possível, a gente vai anotar as perguntas e a gente responde logo na sequência. Tá? Importante, o total das duas sessões não deve passar de 30 a 35 minutos, que é um formato mais simples e curto. A ideia é justamente essa, fornecer uma atualização completa, ao mesmo tempo que a gente mantém a conversa objetiva e focada nos pontos mais importantes. Com tudo isso dito, só apresentar formalmente aí o Tarek. O Tarek ele é sócio e Senior Client Portfolio Manager na Man HL. Ele é parte integrante do time de investimento e, ao mesmo tempo, ele assume parte da responsabilidade de conseguir transmitir para os clientes tudo que o Target Risk consegue oferecer para os investidores. Com tudo isso dito, espero que gostem do webinar. A gente vai passar agora para o inglês para poder incluir o Tarek no papo. So Tarek, first of all, thank you very much for being here with us today. It's always a pleasure. And I'm sure it will be very helpful to everyone on the line to hear more about what happened in the market in the last couple of months, and actually throughout this year, and how this man has been navigating this uncertain environment with its systematic approach, and what to expect next from now until the end of 2023. So Tarek, thanks again, and I'll pass the word to you.
Thank you, Rodrigo, and thanks to everyone. Every quarter I have the delight to kind of talk to you about, what has happened, and more importantly, kind of how, from the lens of a quant systematic managers, we can see the world. So I'm going to show you some slides, some ideas that we and everyone behind me here are looking at. What are the things which are hopefully going to give you a market perspective, yet from a different angle than the typical view you might see from discretionary approach. So let me kick it off by looking at one of the major changes we've seen this quarter, which is volatility. So I'm going to share my screen, and hopefully you're going to see it in the next few seconds. Can you see it, Rodrigo? Are you able to see my screen?
Yep, all good.
Perfect. So I'm going to start, by one piece of research that myself and my colleague AHL wrote, and it's published and it's available on our website. You can see the footnote, a direct link to it. And what we start talking about is this idea of great disinflation in US and in Europe. And it's true that since February 2023, when Jerome Powell very famously in the Washington, D.C. club said that the disinflationary process has begun. We have seen disinflationary pressures in the US, in the UK, and in the EU. This is the obvious bit. But what is a little bit less obvious is the difference and change in disinflation across multiple countries. Look at the US, way far ahead. Look at EU, slightly behind, and look at UK, still significantly behind both EU and the US. Now, what does that tell you? That does tell you once more that although the overall macro environment could be heading in one direction, it's quite important to keep a diversified allocation to multiple regions, multiple indices, multiple asset classes, because even if you knew that this inflation is happening, it's hard to forecast where it will start, where it will begin, and what will happen next. And hence, this should be a reinforcement, an interesting perspective, slightly different from the disinflation review, that yes, it's happening, but not everywhere at the same speed, and diversification is here quite to help you. Now, the second point which caught our attention is a so-called Fed model. So what the Fed model is really looking at, it's quite a simplistic, perhaps you could even call it naive, looking at many assumptions, but it's quite an intuitive way to look at equity and bond relationship. So the big questions we had, and we have from multiple large investors, is that should we invest back in bonds? Are bonds back to attractive levels? And again, one very simple way to do it is to look at the 10-year yield, which is in dark blue, and the S&P 12 months earnings yield, so the forward earnings yield on equities. And the first observation you see is that you see a compression or a spread kind of reducing between these two forward earning yields. And what this is kind of telling you is that in 2011, from an earning perspective, you much rather be in equities, which gave you a forward earning yield of up to 9%, while bonds were at 2%. So you clearly things were more tilted toward equities and much less toward bonds. If you fast forward till today, the yield difference between these two is quite small, at least historically compared. And whilst we're not saying go and buy bonds, what we are truly saying, or what the numbers are truly saying, is that the opportunity cost between bonds and equities is quite similar, and hence you want to be in a truly diversified portfolio of equities and bonds, because nowadays, going forward, at least the expectation for yields is quite similar between asset classes and less tilted toward one or the other. Now, how else can you look at it? Well, one different way to look at it is to look at valuation percentile. So the left-hand side, the horizontal left-hand side, the x-axis is between 0 and 100. And the y-axis is the forward earnings, again, between 0 and 40%. The first observation, if you look at this chart, you see kind of a exponential tilted chart. It's going up quite steeply on the left-hand side. And that's easy to understand because, as valuation becomes cheaper, you have higher forward expected earnings. That's already known. But now the interesting bit is how does a forward valuation compares between the 60-40, 60% equities, 40% bonds, and a risk balance portfolio nowadays. Now, what you see is that the yellow line, which representing the forward valuation and earnings of 60-40, is on average lower historically and today than the risk balance portfolio. And where does that come from? That comes from the fact that you have less balanced risk or more equity dominance, if you want, in a 60-40 than what you have in a risk balanced approach of equities and bonds. Now, this is quite interesting, in particular today, because today you have a lower valuation for the risk balance portfolio compared to 60-40, given bonds are relatively cheaper, and you have higher forward earnings, again, compared to the 60-40. So both these aspects give you quite an intuitive indication why risk balance portfolio today might be quite interesting compared to a 60-40. There's also for the nerds, at AHL, we are kind of proud to call ourselves nerds. For the nerds, if you look at the R square of these data points, the R square is actually higher, 0.7 for the blue line and 0.41 for the yellow line. So not only the blue line is higher, but the certainty around these levels are more, we're much more certain of the statistical meaning or definition of these numbers than what you have for the 60/40. So all of it, again, talks for risk balancing the portfolio equally between equities and bonds. And if you're interested in deep diving a bit more in this topic, we have also a different paper which we published, and you see the links in the footnote where we talk about this valuation and how we came to these conclusions. Definitely worth reading and definitely worth keeping in mind. Now let's talk about splitting the world if you want. One is from the 1970s. And honestly, we picked 1970 because this is where we have the most complete set of data. From 1970 till 2014, and then 2014 onwards. So if you go from 1970 till 2014, you see the long-term Sharpe ratios of equities and bonds, as you would expect, roughly similar, 0.3 to 0.4. If you look much more recently, from 2015 onwards, you see that the equity Sharpe ratio is 0.6, while the bond Sharpe ratio is flat, even negative. So what this is telling you that while equity Sharpe has been dominating, it has not always been the case that equity Sharpe ratio is significantly higher. If combined with this information with valuation of equities, which are quite higher, you would expect going forward a normalization, if you want, of the Sharpe ratio. Hence, again, not saying buy bonds, but you're saying a risk balance portfolio is much better positioned than a pure equity portfolio or a 60/40 portfolio, which is effectively dominated by equity risk. Let's talk about target risk. For everyone on this call, I am sure you're all very well aware of how target risk works. Target risk is a risk-balanced approach across equities, bonds, credit, and inflation. And on top of the allocation, we have multiple overlays, the volatility overlay, the momentum overlay, and the correlation overlay. And what these overlay do is they cut down risk whenever you go into a period of high market volatility or a period of strong negative momentum or a spike in correlation, meaning a loss in diversification between equities and bonds. And so the way to think about target risk is a strategy which is running a good, healthy degree of risk when markets are okay, when everything is rallying. But as soon as you have issues in the market, it automatically dials down the exposure to make sure we don't have as much exposure whenever risk and markets are in sell-off mode. And this happens quite quickly. So you see here from 2014 onwards, we're going to deep dive a little bit more on the last quarter in the next slide. But so far you see that from 2014 onwards, it's highly dynamic. This is the exposure of the strategy, which can be cut in a matter of days. And then you go back in and again, cut and go back in a very, very, very short-term period, because it's all systematic. It's all based on data. It's all based on facts. It's all based on prices. As soon as the volatility starts increasing, next day we can automatically start cutting down risk if need be, and if the thresholds are met. So what happened so far this year? I would say this year has been split in broadly two phases. The first phase is Jan 23 till almost end of July, not exactly, but almost end of July, where you see a steady increase in market exposure in target risk. So the blue line is the equity exposure, yellow line is bonds, light blue line is credit, and green line is the inflation. These two lines, the dark one is MSCI World, and the orange one is government bond. Now, what is quite interesting, you see a steady increase in exposure in the portfolio on the back of volatilities going down in market, correlation improving in markets, and things behaving as it would in a risk-on scenario. And in fact, equities have rallied, and we were well able to benefit from this equity rally during this period. Now, what is interesting is at end of July, toward the end of July, suddenly this kind of risk-off mood dominated yet again. Automatically, you have problems, this kind of diversification between equities and bonds wasn't there anymore. You've had losses, piling up on equities and bonds, and all of a sudden, the correlation overlay activates fully systematically, of course, to cut down the portfolio exposure to around 120% and cutting down by halving, if you want, the exposure we've had before the early volatility. So, textbook example, yet another one where we were able to cut down the exposure quite quickly ahead or just after the start of the volatilities we've seen in markets. And in fact, today, so this is as of end of September, but of course we are already in October. Today we have seen the overlays activating even more and cutting down the exposure to even higher level of around 80% exposure. So the overlays were quick. They were able to capture, or to understand the increased market volatility, to understand the increase in correlation in the markets, and to react very quickly and adapt to it. So how has the performance been? Performance as of end of September has been plus 5.9%, with third quarter minus 1.3, comparing to minus 2.3 for a 60/40 portfolio. So overall, year to date, we are 5.9% and 60/40 at 7.9, notwithstanding the fact that we're much more balanced and we're much more able to benefit both from equities and from bonds. And this is what you see on the right-hand side. So even though we were able to benefit from stocks, from stocks year to date, overall, you've had a performance year to date really driven by risk on assets, so stocks and credit, and slight detractions of bonds and inflation. Now, the important point here to mention that even though bonds have sold off, the losses were limited to 1.6 because, again, we have the risk controls activating and cutting down risk quite quickly. So what overlays are active? As of the end of September, as you can see on the slide, the correlation overlay was active fully. We've had some momentum overlays active on bonds, a little bit on inflation, more particular around inflation-linked bonds and on equities. But the recent interesting development for you to be aware of is that now the volatility overlay, the one on top, has activated as well. And now we have the vol overlay cutting down portfolio risk to even lower levels than the one you saw earlier on the chart, as I mentioned, to around 80% exposure. How do we stack up versus peers? Well, we stack up quite nicely. You see target risk, which is the dark blue line on top, is doing well versus main peers. Now note that these peers are not randomly chosen. These peers are part of the same benchmark which you see in the footnote, and we haven't removed nor added any peer to make us look better than the bench. These are all of the peers, and we do quite nicely compared to all of these peers. In terms of numbers, as of end of July, these numbers always come with a certain degree of lag. Annualized return stays at 7.6%. Peer A till F are at lower levels. Volatility, again, lower vol on average, and a Sharpe ratio of 0.6, which will compare against the peers, which is anywhere between 0.14 and 0.37. So almost double the best peer that exists in this space. And finally, the Sortino ratio, again, was 1.05. This is telling you that for every unit of bad volatility, we are able to take more than any unit of performance return. These are the healthy numbers you would like to see, and this is what Target Risk has so far been able to deliver. So this was, if you want, a broad overview of where we are today, the positioning, and the performance. Rodrigo?
Great, Eric. Thank you very much for the presentation. To kick off the Q&A session, we received one question from the audience regarding the effect that both wars had on the allocation of the portfolio. What was the effect and how did the portfolio behave after the start, firstly, of the war between Russia and Ukraine, and more recently on the Israel and Palestine war? How was the behavior and how did it impact the allocation in the portfolio of target risk?
Yeah, so typically these kind of you know these kind of scare events or scare events are typically good for the portfolio, and I'll tell you why. Um, Now, of course, we don't wish to see these kind of events happening in the market, but typically, whenever you have these kind of big uncertainties around war, whether it was the Russian-Ukrainian invasion, and even like a different example, which is the SVB blow up, when the SVB bank blew up, and even more recently, what you typically tend to see is that people tend to panic and disregard valuation and all of these talk and all of the macro talk and just jump into treasuries to hedge themselves and to make sure that they're not doing the wrong things, which is totally understandable. Now, perhaps not rational, but understandable. So how does target risk benefit from it? From multiple angles. Now, remember, we are not a 60-40 portfolio where 90% of the risk is in equities and 10% in bonds. This portfolio might suffer quite badly from these type of moves where people sell off equities and just buy bonds because the amount of bonds, true bonds we have is quite limited. We have an equal amount of risk between bonds and equities. And as such, we tend to participate more in the bond rally than a 60-40 portfolio typically would. So in a nutshell, these type of events, broadly speaking, from a performance perspective, you don't see an impact, i.e. sometimes you have a beneficial added value to the overall portfolio given your bond allocation.
Thanks, my
Now,
friend.
on top of
Pretty
this,
clear. Yep.
uh, so
Go
this one's the
ahead.
allocation bit, but of course, so Rodrigo, things which I'm sure our audience knows quite well is that on the back of this increased volatility, for example, in bonds or in equities or whatnot, you will have the overlays kicking off. And now, as we see today, we have the vol overlay activating, we have the correlation overlay activating. So all of these will even go further and reduce, not just on the entire portfolio level. No, the vol overlay could activate on equity level, on credit level, or on inflation level. So it would activate at multiple granular level to cut down the portfolio exposure. The momentum overlay could activate on market by market level. So all of it is happening in the background in the portfolio while the correlation overlay and will manage the entire exposure. You have much more granular, or the model have much more granular capability to adjust the exposure market by market level.
Great, my friend. Pretty clear. Thanks for your answer. We are getting near the end of the event. We have time for one more question. Something that I always like to ask you about. I mean, you're the go-to person. You're the specialist when it comes to target risk, and you're very used to talking with different types of investors in different regions and different types of profiles in terms of investing. How does global investors are using target risk currently? I mean, what are the benefits that global investors are identifying in the strategy? Why they are investing in target risk currently?
Yeah, so today we manage around roughly $14 billion worth of assets in target risk specifically. And the large majority of our clients are what we call the pure institutional clients, very large clients who want to have exposure to market beta, who wants to hold equities and bonds, but are aware that valuation and what might happen in the future is actually quite worse. I mean, it's very hard to kind of know and be invested in simple, passive investment given everything which could happen. At the same time, they're worried to kind of just abandon equities and bonds and just be in one different asset class and have different type of risk and miss the upside in case the upside happen. One thing we've learned through the years, 30, 40 years of doing what we do, is that forecasting market returns is very hard. It's impossible to know what the S&P will do at the end of the year. And a much more sensible approach is to keep exposure to it, but in a dynamic way, in a way where you can manage the exposure quite quickly, cut down your portfolio exposure when need be, and go back in force whenever you go back into the market. So what the clients use it? Well, they use it as a proxy, if you want, for global market allocation, but with a dynamic risk overlay because they're afraid of missing out on the upside if it happens, but also afraid of completely being exposed to market beta in a way that 60-40 will focus too much on the equity risk. And the final point, which is a bit more tactical, right? A bit more tactical on target risk. Today, while the exposure is much lower than usual, 80%, we see some inflows going into it because at 80% exposure, there's so much more drawdown that could happen because you don't have enough exposure. While if it triggers and market rally, you can make much of the upside. So it's a good entry point for some, but this is more of a tactical consideration. And what we typically find is that most of the client stay in for multiple years and have been from day one into the program and in target risk. So the long term is that this is a dynamic market exposure. You want to have in a diversified, risk balanced, cost effective way with risk overlays. And the second consideration is a short-term, entry point, which might be useful given the low level of exposure and the low potential drawdown.
Perfect, my friend. Crystal clear, makes a lot of sense. I think we are right on the top of the hour. So I would like to thank you once again for being here with us today. It was very insightful, as usual. I'm going to switch back to Portuguese just to wrap up the call. But thank you very much, Derek. It's been a pleasure. Pessoal, com isso a gente chega ao final aqui da nossa atualização. Acho que alguns recados importantes, acho que se vocês quiserem rever alguma parte desse call, esse call fica gravado, a gente consegue disponibilizar a gravação para vocês. A apresentação que o Tarek usou, a gente consegue disponibilizar também. E acho que o último recado se ficou alguma dúvida que vocês queiram abordar a respeito tanto do portfólio, do Target Risk, quanto da MAN, algum tipo de atualização institucional, entre em contato comigo ou com qualquer comercial aqui da HMC ou da Gama. A gente pode endereçar essas perguntas para o pessoal da MAN e, eventualmente, a gente pode marcar calls one-on-one também para a gente abordar qualquer ponto de interesse de vocês, tá bom? Então, com isso, acho que encerramos aqui o webinar. Obrigado pela presença de todos e nos vemos na próxima. Bye, Tarek. Thank you very much.
Thank you all.